Welcome back. The latest financial results from Kenya's banking industry, in which Equity Group is the latest bank to announce a decline in its profitability. Equity Group has reported an 11% drop in its pre-tax profit to post a pre-tax profit of 20.09 billion shillings. Now, the profit dip was recorded against the backdrop of 402% increase in its total loan loss provision to 26.6 billion shillings. Now, the group restructured 171 billion shillings worth of loans for customers whose repayment capacity was adversely impacted by the COVID-19 pandemic. Now, this represented 32% of the bank's entire gross loan book of 530 billion shillings. As of 31st December, 40 billion shillings of the restructured loans had resumed repayment and normalized. Now, the bank waived mobile charges of 1.2 billion shillings to help sensitize clients to adopt mobile, digital, and online banking in compliance with the health protocols of reduced mobility, minimized interactions, promoting hygiene, and maintaining social distancing. Good. Let's cross over to that analysis on exactly how Equity has performed within the coronavirus pandemic. And you can actually see that total interest income, you can see exactly what it's jumping up to. But if you look at that profit before tax, but reduced to 20 billion in profit after tax. That's where the conversation point is coming from. So let's look at exactly what the liabilities and assets have been in the entire of that period as well. And that's the biggest conversation point as well. The total assets now stand at 1 trillion shillings. And if you look at exactly what KCB stands after having paid that 1 shilling per share dividend, they stand at 987. Meaning that Equity now could be standing at the biggest assets right now after that dividend payout season, because we do know also that Cooperative Bank, which is the third lender in the country by assets, now have around 536 billion in terms of assets, because they also went into the payment of that 1 shilling dividend per share and also acquired Jamii Bora Bank that actually gave them 30.6 billion shillings in terms of extra assets to the bank. Let me start with you, Chacha. Let's summarize Equity's performance amid the COVID-19 pandemic. How would you summarize it?
Okay, Simba, I am going to highlight 3 important things about the Equity Bank 2020 financial results. One, that the Equity Bank's pre-tax profit declined by 11%. That is, it declined from around 22.6 billion shillings to 20.1 billion shillings. 2, that Equity, in trying to cope up with the COVID pandemic, restructured the loans to a tune of 171 billion shillings, meaning that there were restructured loan repayments with the customers, and but at all, by 31st December last year, most of the repayments had resumed and normalized to some extent. The third point is about Equity Bank's waiver of the mobile charges, which cost Equity 1.2 billion shillings. Now, what these 3 economic indicators pertaining to Equity Bank mean? 1, Equity, unlike other peers, other banks like KCB, Standard Corp, has frozen the issuance of dividends to their shareholders. Remember, this is the second year they are doing that.
Yes.
Last year they had declared a dividend payment of about 10 billion shillings, but that was withdrawn. It wasn't given out to the shareholders. For this year again, after registering that 11% decline in profit, they have actually not declared any dividend. In fact, they have frozen it. What does that mean now to the shareholders? Compared to other peers, Equity, as we have said, is the second largest bank, in fact, in East and Central Africa, after in terms of asset base.
Yes.
But Kenya, in fact, is the largest in terms of cash flow. What does that mean? Equity is being more conservative, and it is more self-preservative. And if equity has a better asset base than most banks, why doesn't it then give dividends? Because this will actually lead to a decline in investor confidence.
Yes.
Because remember, other banks are giving dividends because they are saying they have a buffer kind of asset base in terms of support. They also want to boost investor confidence. So equity, in other words, it is playing a cautionary game to guard itself from making more losses and to make sure that it remains the largest bank in terms of asset accumulation. But here, the interests of the clients, the shareholders rather, have been relegated. And this is very interesting indeed, although they have said they have tried to restructure the loan repayment period in a manner that is likely to be more friendly to the clients. But equally, the shareholders are not gaining anything. In this case, it is in a catch-22 situation, just like other banks.
Yes.
But it's playing two states for that matter. Thank you.
Pretty much. Reginald, let me also ask you on this issue of a dividend cancellation, because that was the standard point when Equity were announcing the results. We've seen what other banks have done. KCB revised the dividend from the normal 3 shillings and 50 cents to 1 shilling. Coop actually also did the same thing. Stanbic as well, we saw them revise it to just a 1.5 billion payout in terms of dividends. Equity cancelled it all. We're just seeing their assets now stand at 1.1 trillion because, well, they've not paid out that dividend. Should have they paid? Is it okay for them not to pay? And what is the importance of a bank like Equity paying dividends during this time when we do know that the shareholders actually will need those dividends payout?
Okay, Simba. Before I answer the dividend question, I think when you look at Equity's results,
yes,
when you look at a bank, a bank falls or rises on 3 things: how you manage liquidity, how you manage credit risk, and how you manage interest rate risk. Equity has done that very well. The interest income has gone up.
Yes.
The non-funded income has gone up, and they have provided from 3 billion to 23 billion provided for any credit risk. And a provision is not, it's an accounting entry, but it's not an actual loss. So the 23 billion we're seeing there does not mean that they've actually have loan losses of 23 billion.
Yes.
They're just providing. So if any of these start performing again, assuming, let's say they start performing again in 2021, that 23 billion loan loss provision in their P&L goes back to 3 billion. Equity's profits will actually be exceptional, so to speak. And why have they been able to do that? If you go to the balance sheet, you realize their customer deposits increased by close to 100 billion during the pandemic. Under the section of liabilities, the customer deposits increased by close to 100 billion. And what did they do with this 100 billion? 30 something went to government. 30 something went to government securities. So if you look at government securities in 2019 versus 2020, and a good close to 100 billion went to loaning. Banks make money when they loan out money, not when they give it money to government securities. So you go back to the P&L, you realize interest income has gone up. Income from government securities has gone up.
Yes.
The bank is generating money. Profit has reduced because there is the 2 billion on other non-funded income that came down because they removed the fees on M-Pesa, not by choice but by central bank, and the huge loss provision. If you remove those 2 factors, you realize Kenya's Equity Bank's profit will have actually been up by close to 35% this year.
Yes.
So I think they've actually done a stellar job to navigate. But the truth of the pudding will be seen this year on how do those non-performing loan provisions they've done turns out. Because if then they become loan loss, then that's an issue.
Yes.
When you come to dividends, well, it depends on how you look at it as a shareholder. I am actually more worried on companies that dish out dividends like they have nothing else to do. Because that means that company has not seen potential for future growth than better giving the shareholders back that money. If you look at equity, yes, they didn't pay a dividend last year and they've not paid a dividend this year. But what have they done with their money? They finished the acquisition in VRC without borrowing. That means they retained money and they invested in a bank which, in a market where it is exceptional, as in the potential in the DRC is like when equity was starting here in Kenya. And it has the potential of increasing their revenues, if not 3 to 5 fold.
Yes.
So whenever a company is dishing out a lot of dividends, the question that you need to ask yourself is, don't they have future opportunities which, if they retain these funds, they're able to grow the value of the share price and grow the value of revenue, meaning that the share price increases in price. I'll give an example of our dear Safaricom, who have been paying out dividends like they have no other thing to do. And yet at the same point, they're borrowing money to go invest in Ethiopia. And I'm thinking, this is cheaper money. You already have the money. It has no cost to you. Instead of getting a cost where you're borrowing to go and invest in Ethiopia,
yes,
why not retain a 50, 60 billion that you're paying out in dividends to actually do that investment, and your return on investment will be higher because your cost of funding will be very low. So what equity has done is more of retaining to grow the business in terms of having capital growth. So you will see the share price of equity in another 2-3 years will perform better than Stanbic, KCB, and Stanchart, who have dished out dividends. Because truth be said, Kenyan companies have been paying out a lot of dividends because there have been no opportunities in the economy to invest in. And that's why equity has gone outside the country. And they found opportunities which they are growing organically. So they're growing from internal funds and not from borrowing funds. So I don't see it as a bad thing that they didn't pay dividends.
Yes.
As long as we can see, if you look at their cash flow, their cash flow is 226 billion cash and cash equivalents at the end of last year. That's a very liquid bank. And they are making good investments which are growing assets and growing revenue, vis-a-vis KCB, who are making investments which are growing assets but not really growing the revenue. So equity is actually still a bank to watch. They have been able to access cheap funding in the name of lending to SMEs,
yes,
and which has been their strategy: get cheap money at 0.5 to 1% for 10, 20 years, lend it out at 14, 15% to SMEs, and that's how equity has been built. And so I think their strategy is solid. It works for them right now. And as an investor or a shareholder, I shouldn't be worried that I didn't get 1 shilling when I know in a year or two, my share price can have gone up by 40, 50%, which is a better return than eating 1 shilling now during COVID.
Pretty much.
I use it to go get a vaccine or a test.
Pretty much. All right, let me cross over to Chacha. Chacha, quickly therefore, there's another talking point again for equity, even as they give us their results this year as well. We do know that they also did extend moratoriums in terms of payments to those who are taking the loans back all the way, the loans that were active as of last year, and they were extended for another 3 years as well. And they actually said that 35% of that has already been taken up. Does that also affect equity's long-term outlook?
Okay, yeah, that in a way will affect equity's long-term outlook. But as I already pointed out, equity is rather looking more futuristic in terms of how do they get more profitable opportunities they can invest in and so on. They are not looking at maybe the short term. Perhaps maybe this is informed by the effect of the COVID-19, whereby, okay, the economy is not doing well right now, but that does not mean the situation will be the same in 3, 5 years or 10 years coming. So by looking actually more long-term, equity in this case has restructured maybe the way that the kind of loans they're giving to clients, and even restructuring the payment. In other words, they're trying to retain the client and at the same time play safe so that they don't lose or lack money that they can invest actually in other projects. So it is a two-way. In other words, for now, things don't look so good for equity. And whoever would want even to buy shares, let's say at the stock exchange, may look at the fluctuations, the turbulence, and they think that equity in the time being is not doing well. But thinking long term, equity here has a high potential of economic growth.
Yes.
And in fact, it will become one of the leading banks in the country. So the situation is not all that gloomy for equity.
Pretty much. All right, Reginald, clear this conversation. Now, we do know that once the president actually did announce the new wave of containment measures of COVID-19 in the country, there's some shares that have been leading in terms of wealth shedding at the local boost, because we do have equity also among those that have lost by 8.84%. Reginald, why that reaction at the time when equity is also giving you the results that are saying, well, look, we are going to hold that dividend right now?
I think when people look at the bottom line and see 11% decline and do not look into the numbers,
yes,
people make irrational decisions. And as many have said, when the crowd is selling, it's the time to buy. So let them sell. If I was you, Simba, I would look for the money that I have and I would actually go buy. When you buy an organization, you are looking at their management.
Yes.
You're looking at their business model and their business structure, and you're looking at future revenue, not current. And there's nothing that warrants an 8.4% drop in equity results, because most of these things have already been factored in throughout first quarter results last year, second quarter, third quarter. So we definitely knew full year results are not going to be that stellar,
yes,
or that good. But for those who seek dividends, those short-term investors who are hoping that they announce something good so that they can make a few coins here and there, most probably, yes, did pull out. But the business is still solid. The investments they've made are also solid. And for me, nothing much to aid into the 8.4. However, organizations cannot grow bigger than the economy they are in. So as long as the economy is also suffering, and the economy is not expected to grow that much, then you don't expect much to also come out from the Nairobi Stock Exchange in this year up to election, because of the political risks, policy continuity risks, and all those things that are affected in. Yeah.
Pretty much. Reginald Chacha, thank you very much for joining us this morning. That has been your economic review. My name is Simba Elijah Charles Kiaga. Good morning.